Hey, welcome back. Let me describe something that is quietly happening right now and that most retail crypto investors are almost completely unaware of. The largest financial institutions on the planet, including BlackRock, JP Morgan, Goldman Sachs, and sovereign wealth funds managing trillions of dollars, are actively moving real-world financial assets onto blockchain networks. Not experimenting with the idea, not writing research papers about it, actually doing it right now at scale. We're talking about government bonds, real estate, private credit, commodities, and other traditional financial assets being tokenized and placed on public and private blockchains where they can be traded, fractionalized, and used as collateral in ways that were previously impossible. This is called real-world asset tokenization, and it is being described by some of the most respected names in traditional finance as the most significant financial infrastructure change since the internet. The question for crypto investors is not whether this is happening. It clearly is. The question is which specific protocols and projects are positioned to capture the most value from this shift. And that is exactly what today is about. Let us get into it. What are real-world assets and why does tokenization matter? Let us start with a clear definition and then explain why putting these assets on a blockchain is genuinely transformative rather than just a technical novelty. Real-world assets, commonly called RWA, refer to traditional financial and physical assets that exist outside of the native crypto ecosystem. This includes government bonds and treasury bills, corporate bonds and private credit instruments, real estate including commercial and residential property, commodities including gold and oil, equity in private companies, and even things like art, royalties, and infrastructure. These assets collectively represent hundreds of trillions of dollars in value globally, dwarfing the current size of the entire crypto market by many orders of magnitude. Tokenization means creating a digital representation of these assets on a blockchain where ownership, transfer, and settlement all happen through smart contracts rather than through traditional financial intermediaries and their associated slow, expensive, and often opaque processes. Here is why this matters so much and why it is genuinely transformative rather than simply a different technical wrapper around the same thing. First, accessibility. A tokenized government bond can be owned in fractions worth $10 rather than requiring the minimum investment that traditional bond markets demand. This opens asset classes previously available only to wealthy investors to anyone with an internet connection. Second, composability. A tokenized treasury bill sitting on a blockchain can be used as collateral within decentralized finance protocols, generating additional yield while simultaneously maintaining its status as a conservative fixed income asset. This kind of capital efficiency was structurally impossible in traditional finance. Third, settlement speed and cost. Traditional financial asset transfers can take 2 to 3 business days to settle and involve multiple intermediaries, each taking fees. Blockchain settlement happens in seconds or minutes at a fraction of the cost. Fourth, transparency. Every holder of a tokenized asset, every transfer, and every yield payment is permanently recorded and publicly verifiable on the blockchain. This level of transparency does not exist in traditional financial markets. The scale of what is already happening. Before discussing specific DeFi gems in the space, let me give you a sense of the scale of what has already happened, because most retail investors dramatically underestimate how far along this trend already is. BlackRock, the world's largest asset manager, overseeing over $10 trillion, launched a tokenized money market fund on the Ethereum blockchain. Within months of launch, it attracted billions of dollars in investment, becoming one of the fastest growing tokenized fund products in history. Franklin Templeton, another major traditional asset manager, launched its own tokenized government money market fund on multiple blockchain networks. JP Morgan has processed hundreds of billions of dollars in tokenized repo transactions through its own private blockchain network, demonstrating institutional level confidence in the technology. The total value of real world assets tokenized on public blockchains has grown from less than $1 billion to multiple billions within just a few years. And industry projections from firms including McKinsey and Boston Consulting Group estimate this market could reach tens of trillions of dollars within the next decade. These are not speculative projections from crypto enthusiasts. These are projections from traditional financial consulting firms analyzing the business cases being made by their own institutional clients. The institutional validation of this trend is significant for one very specific reason. Institutional capital does not move at retail speed. The fact that the largest financial institutions on the planet are already deploying real products into this space is not the beginning of institutional experimentation. It is the confirmation that the experimentation phase has ended and the deployment phase has begun. For crypto investors, this distinction matters enormously. The projects building the infrastructure and protocols that enable this institutional deployment are operating in a space where demand is not hypothetical. The key protocol categories and DeFi gems. Now let us get into the specific categories of protocols where genuine value is being created within the real-world asset space and the types of projects worth paying attention to within each category. Category 1. Tokenization infrastructure platforms. These are the protocols that provide the core technical infrastructure for creating, managing, and distributing tokenized real-world assets. They handle the compliance layer, the legal structure wrapping, the smart contract architecture for representing ownership, and the connections to traditional financial systems. The protocols that win in this category are those that successfully solve the genuinely hard problems, including regulatory compliance across multiple jurisdictions, legal enforceability of blockchain-based ownership, identity verification for investors, and seamless connection between on-chain systems and traditional financial rails. Projects in this space that have already demonstrated meaningful institutional adoption represent some of the strongest fundamental cases in the entire crypto sector, since their revenue is tied directly to the total value of assets they have tokenized rather than to speculative token demand. Category 2. Decentralized lending protocols accepting RWA as collateral. The next critical layer involves DeFi lending protocols that have integrated real-world assets as accepted collateral. This is where composability becomes genuinely powerful. When a tokenized treasury bill can be deposited as collateral in a decentralized lending protocol to borrow stablecoins that are then deployed elsewhere for additional yield, the capital efficiency created is extraordinary. A conservative government bond earning its base yield while simultaneously generating additional borrowing capacity within DeFi creates returns that are simply impossible in traditional finance through conventional means. Protocols that have successfully integrated high-quality real-world asset collateral have also improved the quality and stability of their own loan books, since real-world asset-backed loans carry fundamentally different risk profiles than purely crypto-collateralized loans, whose value can fall dramatically during market downturns. Category 3. RWA-focused stablecoin and yield products. A third highly compelling category involves stablecoins and yield-bearing products directly backed by real-world assets, rather than by volatile crypto assets or purely algorithmic mechanisms. Treasury-backed stablecoins that pass through the yield from underlying government bonds directly to holders represent a genuinely new financial product. They offer the stability and usability of a stablecoin while generating the yield of a government bond. a combination that did not previously exist in either traditional finance or crypto-native finance. The protocols building these products are attacking an enormous market. Since stablecoins represent one of the most widely used products in all of crypto, and treasury yield is one of the most universally desired characteristics in conservative investment products. How to evaluate RWA projects specifically? Evaluating real-world asset projects requires a slightly different analytical lens than evaluating purely native crypto protocols, because RWA projects exist at the intersection of blockchain technology and traditional financial regulation. Here are the specific evaluation criteria that matter most in this category. Legal structure quality. How robust is the legal structure that connects the on-chain token to the off-chain asset? If the blockchain network went down or the smart contract had a bug, what legal mechanism ensures token holders can still claim their underlying asset? The strongest projects have clear, tested legal structures in multiple jurisdictions, often involving established legal entities as trustees or custodians of the underlying assets. Issuer and custodian credibility. Who is actually holding the underlying real-world assets and verifying that they exist? The most credible projects partner with regulated, established financial institutions as custodians, rather than relying on new, unproven entities to hold billions in real assets. Regulatory compliance track record. Has the project successfully navigated regulatory requirements in its operating jurisdictions? Regulatory compliance in this space is not optional. The projects that have demonstrated ability to operate within regulatory frameworks while still delivering compelling products have a significant competitive advantage over projects that have deferred these questions. Revenue model tied to assets under management. The strongest tokenomics in this space involve protocols that capture revenue as a percentage of the total value of assets they manage or have tokenized. This creates a direct and transparent link between protocol growth and token value that is far more fundamentally grounded than most native crypto token models. The risks worth understanding. No sector analysis would be complete without an honest assessment of the genuine risks involved, and the real-world asset space has specific risk factors worth understanding clearly. Regulatory risk is the most significant. Real-world assets sit directly at the intersection of crypto and traditional financial regulation, making them subject to regulatory scrutiny from multiple directions simultaneously. A regulatory change in a key jurisdiction could significantly impact specific projects, even if the broader sector continues growing. Smart contract risk remains relevant. Even if the underlying assets are high-quality traditional instruments, the smart contracts that represent ownership of those assets can have bugs or vulnerabilities. A hack or exploit of a tokenization smart contract could create significant problems for token holders, even if the underlying assets remain sound. Centralization risk. Many real-world asset protocols rely on centralized entities, specific custodians, specific legal structures, or specific teams to maintain the link between the on-chain token and the off-chain asset. This creates dependency on specific counterparties that purely decentralized crypto protocols do not share. Oracle risk. Bringing real-world asset prices and data onto the blockchain requires oracle systems that can be manipulated or fail. The accuracy and reliability of the price feeds connecting real-world asset values to their on-chain representations is a genuine technical risk factor. Understanding these risks clearly does not mean avoiding the sector. It means sizing positions appropriately and prioritizing projects that have demonstrably addressed these risks through credible legal structures, audited smart contracts, reputable custodians, and regulatory compliance. Real-world asset tokenization is not a future trend. It is a present reality being actively built by the largest financial institutions on the planet, with billions of dollars already deployed and projections suggesting trillions to follow over the next decade. The DeFi protocols capturing this opportunity fall into three main categories: tokenization infrastructure platforms that handle the technical and legal complexity of bringing real assets on-chain; decentralized lending protocols that accept real-world assets as collateral, creating unprecedented capital efficiency; and RWA-backed stablecoins and yield products that combine crypto usability with traditional asset stability. Evaluate projects in this space specifically on legal structure quality, issuer and custodian credibility, regulatory compliance track record, and revenue models directly tied to assets under management. Understand the specific risks of regulatory change, smart contract vulnerability, centralization dependency, and Oracle reliability before sizing any position. Here is the perspective I want to leave you with. Every major financial infrastructure shift in history created enormous value for the protocols and platforms that became the foundational infrastructure of the new system. The tokenization of real-world assets is a genuine infrastructure shift at a scale that dwarfs most of what the crypto industry has previously experienced. The projects building the foundational infrastructure of this shift are worth understanding deeply. If this video gave you a clear picture of the real-world asset opportunity in crypto, please hit the like button and subscribe. Drop a comment below and tell me which category of RWA project you find most compelling. I read every comment. I will see you in the next one.